Who can promise could a seemingly tiny fee, just 0.5% a year, quietly cost you hundreds of thousands of dollars over your lifetime? It sounds almost unbelievable, right? But today on the Capital Breakdown, we're diving into how fees act like a slow leak in your investment bucket, quietly dragging down your long-term returns. By the end of this episode, you'll understand why paying attention to fees matters so much, how they really affect your money over decades, and what simple concepts you can use to spot the impact early. This isn't about chasing the lowest fee at all costs, but knowing how fees work so you're not caught off guard. Let's break it down. The problem or confusion: most folks think of fees as just a small, annoying cost, like a tiny toll on the road to their financial goals. They might glance at a fund's fee percentage and think, "That's nothing, I'll be fine." But here's the catch. That small fee compounds against you over time, shrinking what you actually keep. It's a bit like having a tiny hole in your bucket that you don't notice at first, but as you carry water over a long distance, you lose more and more without realizing it. Many people don't realize that fees aren't one-time charges. They're continuous drags on your returns year after year. And that's why understanding fees goes beyond just looking at numbers. It's about seeing how your money grows net of these costs. Core concept explained. Let's picture your investments like a garden hose filling a big bucket with water. The water's your returns, the money your investments earn over time. Now, imagine there's a small leak in the bucket. That leak is your fee. Even if it's just a tiny hole, over many years, the bucket loses a surprising amount of water. In investing, fees are typically expressed as a percentage, say 0.5% or 1% annually, and are taken out of your investment returns. The key terms here are gross returns, which is what your investments earn before fees, and net returns, which is what you actually keep after fees. Fees create drag, meaning they reduce the speed and size of money's growth. The longer you invest, the bigger the impact of that drag. Core concept explained, continued, think of it like running a marathon while carrying a small backpack. The backpack might seem light at first, but mile after mile, it slows you down and drains your energy. Fees are that backpack for your money. Even if a fund or product performs well before fees, the fees take a slice off the top each year. So your investment's growth compounds on a smaller base. Compound growth is powerful because returns build on previous returns, but fees chip away at that foundation every step of the way. Understanding this helps you see why fees aren't just about what you pay today, but what you miss out on in the future. How it actually works behind the scenes. Fees pay for the people and systems helping manage and operate your investments. Think of fund managers, brokers, and financial firms who provide access to funds or stocks, plus the regulators who oversee fairness. When you invest in a fund, the fee is usually taken automatically as a percentage of your assets under management, often called an expense ratio. This fee covers things like research, administration, marketing, and compliance. But it's important to remember, the fee doesn't just disappear. It's deducted from your returns before you see them. Over time, even small differences in fees between funds can lead to big differences in what you actually keep. So, fees are the cost of accessing investment services, but it's vital to weigh whether that cost makes sense for your goals. How it actually works, continued. Another layer is how fees and performance interact. If a fund charges a higher fee but outperforms significantly, the higher cost might be worth it. But many funds with higher fees don't consistently beat their benchmarks. Meanwhile, low-fee options like broad index funds or ETFs offer market returns with minimal drag. Brokers sometimes add commissions or trading fees, and active trading can increase costs too. So, fees aren't just a fixed number. They come in various forms and can sneak in through frequent trading or complex products. Recognizing these different fee types helps you understand where your money is going and how it affects your net returns. Simple, concrete examples. Let's meet two imaginary investors. First, Lisa contributes $500 a month into a broad index fund with a 0.5% annual fee. Over 30 years, assuming an average gross return of 7%, Lisa's investment grows steadily. But because of that 0.5% fee, her final amount is noticeably smaller than it would be with zero fees. That difference could add up to tens of thousands, even six figures, depending on the total invested and time horizon. Then there's Mark, who trades single speculative stocks regularly, chasing quick gains. While he might avoid management fees, he faces other costs, like trading commissions, bid-ask spreads, and tax consequences. Plus, the risk is higher, and frequent trading can erode gains. Both Lisa and Mark pay fees in different ways, and both need to be aware of how those costs affect their results over time. Simple, concrete examples continued. Emotionally, Lisa might feel comfortable with a steady, relatively low-fee approach, focusing on patience and long-term growth. Mark, on the other hand, experiences the stress of market swings, trying to time trades, and sometimes questioning if the effort and costs are worth it. Fees, in both cases, quietly chip away at their potential, but in different ways. This highlights how fees aren't just numbers on paper. They connect deeply with your investing style, risk tolerance, and time horizon. The capital breakdown encourages understanding these mechanics, so you can make choices that fit your unique situation without unrealistic expectations or surprises. Risks, traps, and common mistakes. One common trap is ignoring fees entirely or focusing only on past performance. High fees can turn a promising investment into a poor net performer, especially if the fund doesn't beat its benchmark substantially. Another mistake is concentrating too much in single stocks or leveraged products where volatility and risk are higher. Fees may be lower in some cases, but the risk can overwhelm any cost advantage. Also, impatience leads some investors to trade frequently, increasing costs and taxes, which further drag returns. The key is patience and realistic expectations. Long-term investing rewards discipline, diversification, and keeping costs in check, not chasing flashy high-fee products or quick wins. Risks, traps, and common mistakes continued. Volatility can also confuse investors into making costly decisions. When markets dip, some try to time their way out, incurring extra fees and missing rebounds. Fees compound against you most when you're investing for decades, so starting early and staying consistent is crucial. Remember, no investment is risk-free. Diversification helps reduce risk, but doesn't eliminate it. So, understanding fees is part of a broader picture, including risk management and time horizon. The capital breakdown always emphasizes balancing these elements to build a resilient financial approach. How to think about this tool. Fees are a fundamental piece of your broader financial life. They're like the cost of running your car. You want to maintain it well, but not overpay for unnecessary extras. Before investing, focus on solid budgeting, building an emergency fund, and clarifying your goals. Once your foundation is set, choosing investments with reasonable fees aligned to your objectives makes more sense. Fees shouldn't drive decisions alone, but they're an important factor alongside diversification, risk tolerance, and time horizon. Think of fees as one of many knobs you can adjust in your financial strategy, always balanced against the value and services you receive. How to think about this tool continued. Remember, low fees aren't a magic bullet. They don't guarantee success or protect you from market downturns. Instead, they help you keep more of what your investments earn. The capital breakdown encourages you to view fees as a part of a healthy investing routine, not the only consideration. By understanding fees, you gain more control over your money's growth, which builds confidence and long-term momentum. Keep learning, stay curious, and always be open to revisiting your financial choices as your life changes. Recap and educational disclaimer. So, to recap, small fees might look harmless, but over decades they quietly erode your investment returns, potentially costing you a significant sum. Understanding the difference between gross and net returns helps reveal that impact. Fees pay for services and management, but it's vital to weigh those costs against the value you receive. And finally, fees are just one piece of your financial puzzle. Managing risk, staying patient, and aligning investments with your goals matters just as much. This episode of the Capital Breakdown is purely educational and not personalized financial advice. Always do your own research and consider consulting a qualified professional before making investment decisions. Thanks for joining me today. Keep breaking down those financial mysteries. And I'll see you next time for more smart, steady money insights. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.